So I want to introduce these guys. So obviously you heard from Rickey. I would reiterate, we've worked with Rickey on several deals. He's gotten deals that we weren't having much luck with to the finish line. I'd highly suggest hitting him up if it's something you are in the market for. Also, we got Ed Schaefer up here. So he's the president and CEO of First Federal Bank of Wisconsin. He's been in that role since July 2016. Prior to that, from 2010 to 2016, he served as the president and CEO of Citizens Bank. He has over 25 years of banking experience, including managerial as well as aspects of credit administration, underwriting. In addition to that, he served 7 years as president and CEO of Huntsinger Farms, one of the world's largest grower and processor of horseradish. So very knowledgeable guy we got up here. And also we got Matt. So Matt's has been in the commercial real estate lender for 15 years. Prior to starting his own firm, which his company is Sell Real Estate and Finance, he specializes in commercial mortgage brokerage. So he's closed over $2 billion of real estate deals in his career. So we got 3 hitters up here on the financing forum. I'm excited to get into some questions. So let's take that a step further. So before we get into some of these questions, can each of you kind of provide some more information on yourselves, what you do exactly, and we'll go from there. Maybe start with you, Matt.
Sure. I guess reiterating what you said, I was a CRE lender for about 15 years. Got a little bit tired of the politics of the big bank world, so decided to try to go on my own and do my own deals, spend more time on doing my own deals, and also just being a mortgage broker for my former bank clients. And it was really great for a couple years, although after I did go on my own, COVID hit. So for a little while there, I thought I made the biggest mistake of my life since I didn't have a paycheck anymore, and every deal was getting canceled for about, 3-4 weeks. And but then things picked back up. Rates were really low. Everything was great, and here we are now. And we're still doing deals, but it's a little bit more of a fight to get them done. But we're still doing them and enjoying it. Like Rickey said when he did his intro, I think all of us, it gets us excited to do deals. We want to close, and I think the unfortunate thing might be that we don't really enjoy the closings. It's like, when's the next one? And just always teeing it up for the next deal. Good.
Thank you, Matt. My ability of going through the full spectrum of doing real estate as an individual and running manufacturing companies and being in the banking space. I was an executive at a company called Norwest out of the Twin Cities. We bought a little bank in California that was failing in 2000 called Wells Fargo, and we changed the name. Norwest was a beautifully run community bank. We could do deals. You could do deals. I ran Western Wisconsin from Eau Claire to La Crosse, a couple $1 billion in assets. I could make the loan myself up to $3 million. We controlled the whole market in the community bank space. If you look at Wells Fargo in those markets today, they had to take on the big bank focus. They couldn't put that authority out like a community bank can. And we'll get into community banks later. So instead of going to California on the stagecoach, I ran a little company and grew it. It's called Silver Spring Foods, Huntsinger Farms. If you were at the Packer game and you put some horseradish in your Bloody Mary, it's made in Eau Claire, Wisconsin. If you've had a bratwurst from Johnsonville with beer and brat mustard, that's the little company. And it was really good to get out of banking because banking was really boring. I was done by 10 o'clock and I was like, what am I going to do? So I did real estate deals and bought small companies. And then a bank was failing and in that market that had just gone public. It was a mutual bank. There are a couple of them down here. Great Midwest is still a mutual, North Shore is. And they converted to a public entity. And they asked me to go on the board. And what I did was switched. I went on the board of the food company and let the family, the son, run the company. He's still president. And we grew that bank from $500 million. It's currently $2 billion. I'm from Milwaukee. And there are a few mutuals down here, and there was an irrelevant bank in Waukesha called First Federal Savings Bank. They made mortgages. And I was approached by the board, would you like to come home, take the bank public, and build a community bank? So luckily, from 2016 to 2020, we went public and closed January of 2020, raising roughly $100 million. So we had the ability to build a platform to do CRE, C&I, true community bank, like I was doing at Norwest. When I grew up, Rickey was talking about First Star. I worked for First Wisconsin. And you knew who the president was. You could go to Marine and you could go to M&I and you could get a deal done. You knew who those people were. We want, and what we structured on this deal, we want to build a community bank. I don't know what it's going to look like, but we're a small part of it, that you can do the same thing. Because on most cases, you can't get the decision from the lender why they did that deal. Okay? You deserve an answer. And it could be as simple as we have 22 hotels in our portfolio and we can't do another one. You'd all understand that. But the we're not lending answer, that's pathetic. So we formed this bank to do that. Create a community bank where you can get to a decision maker, a quick local decision. And it's been very successful.
That's a really tough act to follow, sitting next to a bank CEO. I'm just hustling deals. I really don't know what to say after that one. I guess I'll jump on the we're not lending thing. So I think the majority of you want to know really what's going on in the market. Like, can you get money? How do you get money? And that's why the three of us are here today. As much as we want to talk about our backgrounds and deals we've done and so on and so forth, and we can do that for hours and hours. I think today it's important that you understand there is absolutely a way to get financing for your projects. It's just what kind of financing you can get. And after talking to several of you, I think that's the consensus in the room. So hopefully you get some Q&A time and our contact information after to get your questions or concerns answered. So
sounds good. Yeah, so I kind of want to go right into that aspect. So there's, obviously everyone knows rates are up. It's tough to get money. There's banks collapsing. I have several banks I've heard of in the past month that are just kind of shutting down lending for the rest of the year. So I want to go right into a topic that I think we really want to dive into today, which is what are some of the current trends in the real estate market that are impacting lending and investment decisions from your perspective as you're looking at it?
should I just go first?
Sure. I think fear is the biggest thing. I went to a small bankers conference in May, and one of the panels had all the regulators, the bank regulators were on it. And I'm in this room with all these credit officers at different banks, and these regulators were scaring the crap out of these bankers, telling them, rates were at, I think, 6.5%, 7% back then, and they're like, you need to stress the rates another 2.5 points. And you need to be at a DSCR of 1.35. It's like, whoa, man, that's gonna shut everything down. And you see them all taking notes, and they're looking like, oh, this is really bad. And the Fed, the messaging they're putting out there every time they meet is just, I think it's spooking the lenders. I think there's a liquidity issue. Ed can probably speak more intelligently to that, where they're in a low liquidity position and they're really afraid, I think, of having any more money go out the door. They think there might be some regulations coming that they wouldn't hit a certain matrix they need to be in or have a certain threshold of liquidity. But really, I think the real estate market itself is still strong. The fundamentals of it are strong. So I think what's affecting people is fear. There is some fear that is well-founded, which is the folks that got money at 80% leverage, 30-year amortization, and a 3.5% rate 3 to 5 years ago. What does that look like when that comes up for renewal? If you don't have a deep pocket that you can right-size your loan, then there could be some issues. So I think there is some consternation around that potentially happening. But other than that, I don't really see a whole lot of well-founded fear that these banks have of why they're saying they're not lending. And to Ed's point, for them just to say, oh, we're not lending, we're on the sidelines right now, but we love your deposits, that's total BS. like let's figure out a way to make the deal work, or at least give me a term sheet or some terms that I can say no to, but at least show me you're taking the time to put some effort into what I'm proposing to you.
My father told me once, if you can't get a real job, become a banker. I didn't listen very well, I guess. I think I agree with Matt in regards to, yeah, I mean, there are deals out there that were done at 3.5%. They're going to be, so there's a lot of fear, but don't let your banker scare you. I'm not a banker. I run a bank. It's a very complicated business to run nowadays than it was in 2000. The key is understanding the regulators and not letting them dictate. And when somebody says to you, I can't do this because of policy or the regulators, they don't really understand your business and they're not creating the value you need to help you through the process. We may tell you something you don't want to hear, but we're going to give you advice. And I'm pushing for the community bank market. That's what we do. That's what Rickey does. That's what Matt does. Here's the reality of the situation. If you have a 3%, 3.5% deal that's coming due right now, you could be 100% full, and it could have been just built. You may get a cash call, but you have to be proactive with your banker. You have to be proactive with your accountant. You have to be with your lawyer, and it's easy to solve. Communicate. So don't let the fear scare you, or don't let somebody tell you it's somebody else's issue. Have them provide the value to help you make that decision, because what you've created with that lender, accountant, or lawyer is a relationship, and that's how you get through this stuff. We'll get through this.
Both answers were spot on. You know, the question was, how are the current trends affecting the lending environment? What fear and bank examiners, it's absolutely correct. And sometimes bankers don't know how to communicate that. I think Ed did a really good job saying that some of them kind of hide behind certain vague answers. And at the end of the day, it's really not up to them. Sometimes their management has direction saying, we're not going to lend right now at all. We're just going to collect our principal payments. Try your best to not be mad at the banks for giving you that answer. It's not that they don't want to lend. It's that the direction they've been given. It's the fear that Matt alluded to from the regulators, the examiners. I mean, we speak to banks every single day, like 15 to 20 different lending institutions. And it's very common that they strike fear in them saying, you don't have enough cash, or the term liquidity. Meaning you have long-term investments and illiquid assets, and if something happens to any of these loans that you have in your books, you can't cover them. If these lines of credit that you have for these operating businesses all get drawn, you don't have enough cash to cover them. So what are they doing? What are they doing? They're going and saying, hey, we have a 5% money market special. We need deposits, we need deposits, we need deposits. They really do need deposits. Not every banker is like Ed or Big Mike in the audience, or others that give it to you straight. There's some really, really good bankers out there that we work with that are intellectual and give you good answers, but it is true that these government officials strike fear in them. That's a fact.
So I forget the exact stat, but I know over the next year there's hundreds of billions of dollars of notes coming due, right? And there's plenty of people over the past few years that bought on these 3% rates, 3.5% rates, maybe overpaid for a property, and their notes coming due. I personally haven't seen like a ton of distressed sellers yet, right, where it's like selling at these huge discounts. But on the back end, you guys seeing stuff that we don't see. What's your thoughts on over the next year? Is there going to be people that are distressed, they got to sell a lot of pain, or like what do you see there?
Go in this order. All right, so there's a lot of different theories as to what's going to happen with these, long amortization balloons that are coming due at low interest rates. So, couple things. The first is that the bank during the renewal process or credit union or whatever is going to say, okay, your rate was 3.5% and you underwrote at a 120 debt service coverage ratio. Cool. And now rates are 7.5, 8.5, whatever the number is with that institution. You have 25 years left. You haven't raised rents. You haven't cut expenses. Or maybe you have. But I mean, you look at like, $2, $3, $4 million loan, 4 or 5% difference in interest rate, your debt service skyrockets. So what does the bank do? Option one is they turn a blind eye. Unlikely. Option two, they say, cash, pay down the loan. And the customer is like, no, or I don't have it, or I can't. Option three is it goes to a division called Special Assets Group. And this is where the term special is not good. Like, not at all. So, yeah, it's not very special. And that's like the beginning of the end. It's very hard to get out of there. And the other option is you say, well, like let's say you have 15 years left on the loan or 20 years left. You're like, well, just stretch out my amortization. Stretch it out. Go 25 or 30. The numbers work, right? Seems common and not lose the loan. Well, that term is called a TDR, or it stands for a troubled debt restructure, meaning the bank then has to say, this is the only way that we can make the deal work. They have to report those to the regulators. Every bank has a different system for this, and maybe they have a certain buffer that they can do that. They can do so many of them, but that's a problem. So then you're left with, oh my God, I have to leave. So I think the answer is we're not seeing that yet. I predict we're going to start seeing it probably at the end of Q1 after these annual reviews come out, people file their taxes. And I think that there's going to be a lot of movement between lenders with customers coming due for renewal.
They've changed the term. TDR is now TDL under the CECL principles of accounting, which are stupid. So what do you do? I mean, a lot of the debt is out in the private market, and Rickey and Matt can speak to that more. But in regards to in the banking space, what's coming due, it's not as dramatic as they make it out. It's not as dire is probably the right term. But we're all going to face it because it's a big number. I mean, the math is what it is. So, does your bank do an EP? That's called extend and pretend. There is no problem. That happened a lot in 2009. And the regulators are looking for those, where they just like, Rickey, I'll take care of you. We're just going to extend it for 2 years. Now, there are reasons to extend it. And I think that's going to help solve some of that. Take a multifamily project. The secondary market did die. The private bond market, the secondary market is coming back, and a lot of you own properties that was your plan. Build it, go 3 years, build up the history, and then sell it to an insurance company or through the secondary market. And we have a lot of customers that's how we're going to extend it. The one thing, when you do that, if you have a deposit relationship and you're their main, if your deposit account is with that bank, they will give you preferential treatment. I have talked to numerous CEOs in the community bank space, and they're actually rewriting these deals ahead of time because they don't want a 3.5% on their loan right now, but they may give you 7% right now, but that rate could be 8% in June.
Yeah, I think that stat is definitely true, but I think it also plays into this fear thing because it's not the banks that have all the debt coming due in the next year or so. It's mostly CMBS markets. It's office loans, which it's gonna be a shit show. But it's not banks that are gonna lose their, sorry for all the swearing, their ass. It's gonna be these CMBSs. And the reason being is people that own office complexes are buildings are pretty smart in that they don't want to sign recourse on that, so they go the CMBS route, and it could be non-recourse. So they're just going to give the keys back. That's going to hurt the office market, but I think since COVID, people that are smart have been staying away from that. You're starting to see some of that, and I read an article about like Atlanta down there. They're starting to see feel some pain down there, but I don't think that the maturities will really hurt us on the banking side until I'd say second half of next year. I think my advice for you guys, if you have your own portfolios, to start doing your own stress testing and say, what does my cash flow look like on a debt service coverage ratio if the rates are 8%? You know, am I going to be able to renew without making a large right sizing of my debt? And then if you're going to have some tight cash flow at that point, you get a couple options, I think. Start putting some money away now, start making some extra principal payments. Or one of my clients, one of the smartest guys I know, he owns, I don't know, I think it's like 20,000 apartment units across the country right now. And he, over the last year, has been doing his own stress testing. And what he's doing is a lot of blending and extending right now. So he's at the 3.5, let's say, and the rate right now, let's say it's 7. He's like, let's just kick it out 3 more years, and I'll pay more now. I'll pay 5%, and he doesn't have to worry about this problem for a few more years, and he has more time to pay his debt down. And he knows at 5%, the deals still work, and his cash flow is good, but at 7, it wouldn't. So that's another strategy you could take if you have your own portfolio now and you're looking to make sure you don't have these difficult conversations in the future. And then the deposit thing right now, if you're out there looking for a loan, usually the first question they ask you, are you a current customer? Do you have deposits with us? If no, okay, how much are you going to give us on deposits? I don't know if you're seeing that too, but that's the number one thing right now is asking for deposits. If things, this is down the road, and you know, Ed, close your ears, but if you have your money at the bank, that helps now, but if you're going down the wrong path and there's going to be a problem, I would also suggest, having been on the special assets group, you need to take your money out of where your bad loan is, because the first thing they're going to do is grab that and pay your loan down.
So we obviously, you know, lending is tightening up, as you guys are mentioning. So what sort of metrics are you guys looking at when qualifying someone for a loan? What are the metrics investors should be looking at to determine, okay, this deal would get funded, the bank would give me the loan on it? What are some of those things you're looking at?
I think before, what was it, LTV was big, then after the recession, loan to cost played another factor. And right now, that stuff doesn't even really matter. It's DSCR, debt service coverage ratio, because the interest rates are driving loan leverage. And LTV can be great, but if the cash flow isn't there to service the debt at 120, 130, you're not going to get the funding.
I mean, cash flow has always been king. The 3 C's, the 5 C's of lending: cash flow, collateral, character. Character is a must. Collateral's fine. You don't win if you're collecting, and then the cash flow is what drives it. And you're hearing tons of things out in the market right now. The bigger banks on a real estate deal, they have metrics in them all. So you 65% loan to cost, 125. You start 135, you start putting that on, you're not lending. So, but cash is always king, and that's the key. Now, one thing that will help is if you have that relationship, just because you've got one property that's not cash flowing, there's some banks that will tell you to pay off that loan, even though they have the whole relationship. That's nuts. Look at your global cash flow as well and see how you service everything. And that's really, at the end of the day, I can go to the regulator and say, yeah, so they got one property. Their global cash flow is above 125, and it's tight, but they've got global cash flow. If you have negative cash flow on the project, negative global cash flow, you need to talk to your lawyer.
I'll add a couple things to those. The first thing is that Well, the way we underwrite is we look at every single aspect of the deal. And at the end of the day, properties don't pay back loans. People pay back loans. So to add on to Ed's point, global cash flow is a term that a lot of lenders use when they take the property cash flow and then all of your personal sources of income and then all of your personal debt payments, and they aggregate it together. And they call that your global. It basically means for every dollar that you and your properties or property spend, what are you getting back in? So it's not just about, your 16 unit performing, it's about everything else you have in your life. And so we look at the entire picture way more than we used to before presenting a deal to any lender. We're going to underwrite the asset itself, and then we're going to underwrite the individual or individuals, because we want to ensure that even if the property's great, that they're not taking all that cash flow and over leveraging themselves to be like a house of cards. So that is a big metric that we use to analyze all of our borrowers.
Got it. So, yeah, like you said, traditional, putting 25, 30% down, looking at those things. Are you guys seeing anything creative right now, right? Like seller financing, for example. Is there anything that's kind of out of the norm and those deals are getting done right now, or is it those are kind of shut down for now? Is there anything people could be looking at if trying to determine a more creative way to approach this?
Definitely. So it's very project dependent. If we're talking about construction as an example, so say you're building a multifamily project, there's a ton of different ways you can get money. The bank is going to give you X leverage. You could use PACE financing, which is basically anything that's related to clean energy. There's private money and government money behind that subsidizes the loans. You can go to debt service coverage lenders. You can go to bridge lenders. You can go to hard money lenders like F Street or other folks that were here today. The list goes on and on. There's seller notes. There's personal notes. So basically what we're talking about is the capital stack, the form in which you could stack all the money to get the deal done. The easiest way is obviously a cash injection. But as we've experienced in some of our deals, we have to play around with all different types of sources to make something work. Customers may not like it, but if you need to get the project done, this is the way that we put it together. There's other ways too, not to get too granular with the answer, but those are the common ways.
Yeah, and I'd say if you're not doing like syndications, if you're just a lone wolf doing your own deals, the easiest way is just, I think Ed alluded to it, cross-collateralizing some of your properties with a lot of equity and have those serve as partial or all the equity for your new project. A deal we just closed yesterday, the seller, in order to make the deal happen, bought his buyer's note down he paid 295 basis points in loan fees in order to get the guy's rate down to 6.5%. But it was a matter of the deal worked at 6.5%, and that's what the rate had to be, or the guy was going to lose a couple $1 million in profit. So I thought that was pretty creative. One lender I work with, what he'll do if the deal is pretty tight on cash flow on its own, but the borrower has good global cash flow, instead of the LLC as the borrower and the individual as the guarantor, he'll make them co-borrowers. And then they're telling the regulators, here's the cash flow. We're not just using this single purpose LLC, we're also using the individual's cash flow from whether it be his regular day job or his real estate portfolio. The seller note thing is interesting, and I'll let Ed speak to that actually, because as a former banker, we hated it. We wouldn't allow it. We definitely wouldn't allow a second to be recorded. So you got to get kind of creative if you do have bank financing involved, how public that seller second would be, I guess.
You must have worked at BMO. We'll do a second mortgage filing behind on a deal, but it ultimately comes down to cash flow and how that's structured. And there are many creative ways to put capital in the deal, and Rickey and Matt went through the various sides of using it. The other thought you have to look at is on construction, and if you're building, if you're in a residential market, how can you put that interest expense on the builder or the contractors tied in? They'll build it in, but for 90 days they tie it in. I've done a couple residential deals recently, and I've seen some of the big ones, big firms who gave back properties, and I'm not going to name them in 08, 09, 10, 11 here. Some residential development, the really good guys, they have great product, meaning great lots, great location, and they get X amount down, and the day the lot's ready to be built on, not to start construction, but when the lot is finalized, they make the borrower go out and finance the lot. So we've got builders out there who have beautiful little 25, 50 lot developments, and they pay us off in 90 days. But how you get creative with, what's the term you learn at Harvard, other people's money. There's creative ways to limit your interest expense as you go through the process if you're developing something. And all the other, the PACE financing, the tax credits, those are ways to obviously get more capital. But at the end of the day, no matter what it looks like, if you're going to have financing or have an investor deck where you have investors putting in money, they want to see the cash flow or the tax ramifications for them for the first couple, 2-3 years, as they want to limit their cash
So
taxes.
this conference is having geared more towards commercial real estate. I know most of your guys' experience on the commercial side, but can we talk through like some of the key differences, especially from like an underwriting perspective when you're qualifying a deal of a residential loan versus a commercial loan?
Sure. So in our world, residential is commercial, just to clarify. So anything that isn't a house that you live in. But for all intents and purposes here, I think what we're referring to is multifamily, anything that's, a couple units and higher. So there are different asset classes. There's office, hotels, which is, leisure and whatever it's under, industrial. What else am I missing? I don't know, a few other ones. What's that? Yeah, retail, medical, MOBs. The way that most lenders look at these different asset classes, and we look at them too, they're risk rated. So if you think about it, multifamily generally gets the lowest debt service coverage out there. 115, 1.2, 1.25, depending on the lender. So again, for every dollar you spend, what are you getting back? The riskier the asset class, so the more likely they are to default, the higher the debt service coverage requirement is. So historically, we've probably seen hotels is the toughest one, probably at a 1.4 cover. It's pretty tough, right? It's like 60% LTV, 65. Now office is right there too. I mean, man, we get office requests. Can't even get somebody to answer our phone call. It's tough. And it's unfortunate because there's some really, really good deals out there, but they're all lumped in together. The problem with riskier asset classes these days is they're all guilty by association. You could have this Marriott could be killing it. They still only do 60, 70% loan to value max. So we underwrite everything based on how different lenders want to see it. We risk rate it, we shock test it, and hope to get them done.
Are you talking residential, like 1 to 4 family?
1 to 4, yep.
Yeah, I don't really have a large knowledge base on that, to be honest. You know what I don't know, and I don't know that market. So.
I totally agree with what Rickey said in regards to it. Banks typically like multifamily. It's less risky. There's been a lot of that added, and I think it's being supported because try and build a house today and make it affordable. So that market's going to probably remain strong. But
So we talked about different asset classes. Could we go a little bit further into saying like, what is the you could use the word like darlings right now, right? Like what asset classes, multifamily, industrial, retail, right? What asset classes are you going out talking to lenders and they're saying like, yeah, right away? What are the ones that are saying no quickly to?
I mean,
They love deposits.
that's the best asset class. Yeah. I mean, apartments and industrial. E-commerce is still killing it. Retail was very difficult during COVID, right? I mean, because everything was shut down. It's barely bouncing back. And it's only bouncing back with like grocery store anchored type of buildings. That's retail. The new word to get retail a little bit stronger is medtail. So like medical offices, like a dental clinic and optometry clinic mixed with some retail. That's a little bit better. And then it kind of goes down from there. You know, office is tough again, and hotels are still riskier. I think other asset classes that are really hard, Airbnbs. Oh my God, they are like, it's like the redheaded stepchild. Like you have a random Airbnb, like don't get it twisted, it's a hotel. It's a startup hotel. If you are buying something and you've never done an Airbnb and you are going out to a lender, good luck.
Yeah, don't tell them it's an Airbnb.
Don't tell them it's an Airbnb. Just say you don't have a lease. Say it's vacant, but don't say it's an Airbnb. No, you don't want to lie, but I don't know. That's really hard.
But you don't want to tell the truth.
Yeah. And
If you want the loan.
Right. And just to add to the 1 to 4 families, we do a lot of those deals. I would say the banks are generally less interested than they used to be on them. They don't want a bunch of scattered sites in one loan. It's hard to unwind. It's a lot of work to do them. They still do, but they're just going to price them higher. So there's other lending sources for that than banks.
Yeah. On the property type discussion, I had an interesting call today. It was from a former bank client of mine. I did work at BMO, by the way. This wasn't BMO though. It was another large local bank. And he said, "Hey, I just want to let you know I closed on the refi of my retail property. It's not really retail. It's a Culver's standalone. No Culver's has ever closed, by the way. It's like solid credit." And he said, "Yeah, I said, why'd you refi out of there?" He's like, "Well, your former lender told me I was in special assets and I had to." I said, "Aren't you at like 40% loan to value?" And this guy is solid, signs full recourse. He said, "Yeah." They said, "No more retail in the bank," and I had to exit. So I mean, some lenders, why they do those things, it's mind-boggling. You're turning down great revenue for what reason? And then the word spreads in the community. You get a bad reputation. So another unsolicited piece of advice is community banks are where you want to be until you get too big for them, and then you still want to try to make a way to get a couple to work together, because these large banks will make these decisions. Someone that's not even in your market, somewhere in some office in some other state, is going to say, "I read an article in the Wall Street Journal that said retail is bad. No retail. Tell everyone." Some kind of crazy decision, and it's going to affect you. Being able to talk to somebody locally is huge. It is huge. So also relationships with your community lenders are going to be the best thing you can do is make those connections and establish and solidify your relationships. It is a complete relationship business, developing, being a landlord, and your lender. That's the biggest relationship, in my opinion, maybe I'm biased, that you need to have, because they have the access to the largest part of your capital stack on any deal you're going to do.
Matt, do I owe you money for that plug for community banks?
No, yeah.
And by the way,
I work for cocktails.
we have Culver's. When you talk about asset classes, that's one franchise that the cash flow on those is phenomenal. Those are fairly easy to finance. And then C&I, not on the C&I, but the industrial space, just to get how hot that is from southeast Wisconsin to Madison, we haven't held a property longer in a spec construction longer than 3 years with it going secondary. Yeah, that market's just been hot. It probably will slow with rates going up. But
So we talked about different sorts of lending sources, right? Like we throw out these words: agency, CMBS, local banks. Can we talk about like what the pros and cons are to some of that? I mean, I know for us, we've done an agency debt deal and didn't have a great experience. Now we've slowly worked with local banks. So just so people get a better idea of like what those are and the pros and cons of those.
Okay, so agency is defined as like Fannie, Freddie, HUD, commercial mortgage-backed securities. Basically, these are non-recourse or non-personally guaranteed loans. Well, they have something called bad boy carve-outs, which is a term that means, hey, you don't have to sign on the dotted line, but if we find out that you defrauded us, we're coming after you. So in theory, anybody could sue somebody for anything as long as they get a judge to bite off on it. But like what Scott talked about earlier this morning, like a HUD deal, those advantages are you could do a 35-year fix with no personal guarantee, or if you do the construction with HUD, you can get a 40-year fix with no personal guarantee. The other advantages to agency debt are usually a lower debt service coverage requirement. I think HUD's at like 117 or 118 for multifamily today, and they also do like senior housing, assisted living, things like that. So they won't work with every single asset class, and especially if there's like different services within there, like memory care, and we can go on and on forever. Commercial mortgage-backed securities are usually designed for multi-tenant buildings like retail, office, mixed use, quirky type stuff, generally like, 1.4 debt service coverage or something like that. So the advantages are non-recourse and they're assumable loans. So an assumable loan means that if you're gonna buy the property from somebody, you can assume their debt as well, which can be good if it's in the beginning of the life cycle of the loan. The advantages to bank loans is you have a relationship. I wanna add to something that Matt said earlier about community banking. The one caveat I'll add is that see if you can find out if your community bank president or CEO, if they have real estate experience personally. Because guys like Ed or Doug Gordon at Waterstone or other guys, they get real estate. Sometimes you can't find this answer out. But I've worked with community banks that they don't look at it that way. You have to do some serious digging on them as much as they do on you. So while a community bank can be an advantage for a quick decision, if you get somebody who doesn't like real estate, that could be a huge disadvantage. I would say the banks are easier to work with generally. Like agency debt's very expensive, it's very time consuming, it's securitized, it's tedious, a lot of legal fees, a lot of inspection fees. So be patient with them, but the long-term benefits are huge.
Yeah, on HUD specifically, I've seen so many friends and clients go down that path because they're allured by the, oh my God, look how long this loan is, this amortization is 40 years, my rate is 2.9%, and it's non-recourse, how amazing. I said, okay, buddy, go ahead and do your thing. 6 months later, they call, and hey, this has been the biggest headache ever, and by the way, I'm out 250 grand in application fees. I just can't do it. I mean, I've never seen a HUD fee less than 250 grand. So if you're gonna do that, it is the best product out there for multifamily, but you have to have the stomach to stomach the fees and the headaches that's gonna come along with the process of getting accepted and it's about a year-long process usually. They say it's 6 months, it's never 6 months. Freddie, Fannie, I like them. Little more flexibility than some others, but it's non-recourse, but also, I mean, when they say it's assumable if the guy you're selling your property to is stronger than you. If he's not, I've not seen him approve an assumption. The CMBS stuff, I feel like it's just a matter of, I think what Scott said this morning was your risk profile. If you really want non-recourse, that's the way to go. It's the only way to go. Usually on those property types, it's retail and office, commercial. But the issue you have there is inflexibility. Let's say you have a tenant leave your strip center and you need to put some TIs to get a new tenant in there. Well, that's good news money, as we call it, right? But that's not how they see it. They don't want anything changing. They just want to get their monthly payment. So you're going to have to make a large prepayment penalty, most likely, to take them out, go to a bank, get them to give you a loan for the TIs, and then lease it back up, and then pay another fee to go to the CMBS market again, or the life company market. So again, it's just your risk profile. The greatest thing is it's non-recourse. So all those guys that didn't have a big appetite for risk, well, I guess you have to do office. But if they didn't want to sign the recourse, they went to the CMBS market, and now they're going to lose all their equity, but at least they're going to walk away without having to file bankruptcy because they're going to get sued on their guarantee. So I think Rickey and I both would agree that bank financing is the way to go. But again, if personal recourse keeps you up at night, no one wants to be up at night, so then that agency debt is the way to go.
Yeah, in regards, community banks we're short term. We use Ricky and Matt, and some of the corporate banks in town have really good, strong capabilities at entering the bond market as well. But you have to know what you're getting into.
So we talked a lot about today about raising money, how to find investors, all this thing. But at the end of the day, the bank is your biggest partner in the deal, right? They're gonna have the most money into the deal. So what advice would you give to people that are to cultivate those relationships, right? Make banking relationships. What's some advice you'd give to people to go out and do that?
I think you need to be going out with them, find out what they like, and make a personal relationship. You need to make your lender, in your case, your personal friend. Those are the people that are going to stretch for you when you need someone to stretch for you. Do they like golf? Go golfing. Do they like dinner and drinks? Go do that. And I think, not to keep mentioning Scott, but his presentation was awesome today. And he said, you need to be out there as many nights of the week as you can, because you're going to make these connections stronger, or you're going to make new connections. And that's 100% right. And, to the point it won't affect your personal life at home, be out at every event you can, to develop more relationships, but then make sure you're actually like nurturing those relationships. And once you close deals, make sure you're appreciative. And another thing that I would say you should not do is bankers don't appreciate it if they've gone above and beyond for you, and then you come back and say, well, I shopped you around and so bank is offering a 16th of a point less. Can you match that? That's just want to say, no, you know what, go away. And you've kind of killed that relationship because they don't feel appreciated. So make your banker feel appreciated.
So true. Yeah, you pull that on a banker, and you've lost the key in any relationship. It's called trust, and you build that trust, and you ask those questions of that banker or your attorney or your accountant, and you garner trust, and that's how you build the relationship, and you ask them the hard questions. Can you get this deal done? And they should be able to tell you up front, because a quick no is as important as a yes, or here's how we can do the deal. I could ask a question: how many people out there have gone all the way to 2 weeks before closing and they told you at the last second they couldn't get it done? I mean, that just can't happen. That's just not right. So we call it the community bank difference, and these guys have been throwing plugs in. It's a quick local decision making, really good customer service, and we care about the communities we're in. It's really a simple business, but being able to add value and garner trust and say no. And sometimes you don't. I've had every word used against me in a swear word, because money and blood are very important to people. But up front, you tell them why. You always get a second chance with that customer.
My advice for any of you guys that are taking out loans or about to take out new loans is you have to look at it as if it was your money you're lending out. If you were lending me money, what would you want to know about me? Probably ask for a lot more information. So the first thing is if the banks are asking you for data, just give it to them and stop complaining. Just stop. They're your biggest partner, as Brock said. Give them the info and move on. It takes more time to complain about something than it does to just download your damn statement and send it to them. That's number one. Number two, be organized. Like, for the love of God, if they give you a form, just fill it out. Don't be sloppy. Like, this is your chance to make an impression on them, and a positive impression. That's another piece of advice. The third thing is, if you see an email or a call come in or a text from them, 24 hours, no more, respond. Acknowledge it. Say, I got it. I'm out of town. My CPA is not done. Something. Don't ghost them. You ghost them, even if you're shopping them, whatever the situation is, you go to the bottom of the pile. The more times they have to touch your file, and by the way, you are a file until you are a customer. You are not a person until you have a relationship with them. Until then, you are a number. That's a fact. So, and right now, they have the supply. There's way more demand than there is supply. So be organized, be responsive, be courteous, be kind, play the game, fill out the forms, don't complain, and you get your deals done. And then you get the relationship. Then you get to learn about Ed and Kyle, who's out there, and other guys. And then you go golfing or whatever you got to do. But until then, just do what they say.
I have a very granular add-on to what Rickey said about the organization. I was going to actually interrupt you and say organization. You hit me to it. Very granular. Have all your K1s in a folder where if someone asks for your K1s, you can just send them to them immediately.
Yeah. And one more thing, for those of you that send the first page of your tax return, it's not 1985. Send the whole thing. Seriously.
Sign the PFS. Don't send me an Excel version.
All right, so I got one, and not to pin you guys against each other here, but so obviously Rickey and Matt are on the brokerage side, so they go out, they'll talk to 15, 20 banks, get you the best deal. Where Ed is the bank, right? They're writing the loan directly to you. What are some of the pros and cons if someone's thinking about, should I go right to a bank? Should I go work with a broker? What should they be thinking about when they're trying to make that decision?
Well, I think Matt and I would hope that you'd use both of us versus going to Ed right away, but we'll take you to Ed, no problem. Matt and I are very friendly competitors, for the record. We do a lot of joint work together. He's a highly intelligent human being, and we've worked on a lot of projects together. So we have a very different relationship. So in today's, well, for us specifically, we probably have double to triple the amount of deals that we did last year. And a lot of that is because of the uncertainty in lending. So customers hire us because either A, they just don't want to deal with it. They can be qualified and they're like, you have the sources, go figure it out, we'll pay you for your time at the end. Have a good day. That's the first customer that hires us. The second one is like, I went to the bank and they're not lending anymore and I don't know what to do and I'm under the gun, and I'm like, okay, no problem. We'll drop everything and do it. That's what Matt and I do. We really don't like going to 15 to 20 banks. That's insanity for us. Number one, and I don't want to speak for Matt, obviously he'll chime in, we don't want your information floating around to that many places. Like, it's just, people talk, there's cybersecurity issues. Then we have to say no to 14 or 15 banks? Like, that's crazy. We don't have the time to do it. What we do differently in our advantage is that after we underwrite and understand the deal, the art of it is knowing where to place it. Different customers belong with different institutions. Sometimes it's a function of the asset, sometimes it's a function of what they look like, sometimes it's a function of Ed's personality that may fit really well. Like, we use a process of elimination to figure out this is where it belongs, or top 5 or 6. Cool.
You should always go to the bank. No, in regards to how you do this, the reason I like working with folks like Rickey, where they have, and Matt, where they have relationships, we don't want to waste your time. There are so many good real estate companies and individuals in Wisconsin. We're trained so well through the various schools. There's a lot of knowledge. So you figure out what makes their life easy as well. So we have a lot of brokers who like us because we'll give them a term sheet right away. I don't need a ton of documentation to tell you how we're going to do the deal. Here's the deal. Here's how we're going to lay it out. And does it work? And a lot of time, they'll come back to us, and these are major players in this market, will say, you're so fast and so quick at getting response. By the way, XYZ Bank, the lender just went to a new bank, and that's the best time to go to that bank because they always give that lender a leash for the first 20 deals or 10 deals, and they get deals done cheap. And if Rickey comes to me and says, XYZ Bank has done it for 75 bips under the market, if I can't get a relationship, I'll say, hey, great, that's done. And I'm not wasting his time. So that's a good way in terms of how brokerage firms and banks get along really well. He's got 5 or 6. They tell him, here's how I'm going to structure the deal. There isn't a giant case, a file coming over to the bank where we're pouring through. I don't want to waste my time, and I don't want to waste your time if there's somebody out there in the market doing a deal that's at a crazy rate. We understand that, but we'll always be there and we'll always be consistent. Those are the banks that understand commercial real estate, and those are the ones these guys use.
Yeah, to answer the question, I think go to the bank directly when you have a very strong relationship and rapport with them already. Come to Rickey and I if you're starting out and you don't know necessarily how to make the best case to the bank. We were bankers. We know what we need from you, and we can make probably a better case to the bank because we can speak the same language. And then come to us as well, even if you have your own relationships, if your lender leaves the bank that you have a relationship with, or if you don't think you're getting the best deal with them and you want to see what else is out there. And that can just be a quick conversation with one of us. Yeah, this is what I'm seeing in the market. Oh my gosh, my lender's charging me a point more, or the leverage is 10% less. Then you would want to come to us, or come to us if you have awesome relationships and your banks are telling you right now, sorry, we're not lending. Because I've had a lot of institutional clients in my career who, when I went on my own, they don't need me. They've got 20 people on their staff. They've got a CFO. The CFO has an assistant. They've got an accountant. They should have every relationship covered on the bank side. But over the last 6 to 9 months, it's a really good thing for me that these clients who have stellar credit and have amazing projects and amazing history and backgrounds are calling me to get debt for them. It's like, okay, this is amazing. But it's actually not good for the economy overall and for the financing market when those guys need to call me to get a deal done. And I'm talking about the people that you read about in the business journal all the time, announcing projects one after another. They're finding that, yeah, they've got the projects lined up. They've even got the equity lined up, but now their regional bank is saying, we're not doing the loan. We're shutting down. We're going to see what happens. And we're having to get creative and put on these larger deals for those kinds of clients. Ed's got to come up with 2 of his buddies that own or that run community banks. We've got to team up and get together to make these larger deals happen. I think Mandel Group was just in the Business Journal the other day. They did a deal and they needed to have a 3-bank deal, whereas a year ago that would have been slam dunk. They would have had tons of competition from several banks trying to win that and do that deal on their own. So long-winded answer.
Just to add to that, we have clients that are large developers in the market, and we did a $40 million deal, a $30 million, and a $25 million deal. And we used 3 to 5 community banks. So in the old days, when I first started, you had First Wisconsin downtown, First Wisconsin Brookfield, First Wisconsin Madison, and they'd share participations. We do the same thing with our community bank friends who run other banks around town. So I just wanted to add that that's pretty easy to do.
Yeah, I just want to say too, a disclaimer. I met Ed 10 minutes before this, so he's not paying me or to pump up the community bank share, because it might come across that way.
Okay, awesome. I know we're kind of bumping up against time here. Wanted to give a moment, if there's any questions from any of you guys. Can run through a couple questions.
So since I no longer live in Wisconsin and I want to continue to invest in Wisconsin, but everything I have is 2 units. If I wanted to get lending for, a bigger, 8 to 15 units, how does that relationship work when personally for me, I'm speaking, I don't live here anymore? And my deposits are with, PNC.
Your deposits were with PNC. That's point number 1. They're going to be with the bank that gives you the loan. So there are certain banks, and I'm not going to speak for Ed, that want you to be in market. So they prefer you to be that in that vicinity because they want to see you face to face, just the way they are. We would look for the institution that is in your market where you live that is okay lending in Wisconsin. That's probably the play. I mean, and there are non-bank lenders out there too. Like, we're talking about banks because they produce the majority of the loans. It's the most common one. So, 1 to 4 unit properties, there are lots of debt service coverage lenders that are out there that have very liberal financing too. And then you could park your deposits with the community bank. They don't require them.
Yeah, I think that's one of the cases of when you'd come to Ricky and I versus the bank directly, because we'll know which banks don't have a lending footprint that's very strict, or they can deal with out-of-state borrowers with in-state properties. I mean, at least you have the properties in market here. Like the deal we closed this week, it was Ohio borrower, Indiana property, Wisconsin bank. There was one policy exception there, but I felt like I was able to use my relationship with that lender and that bank in order to get them to say, okay, we're going to do this deal, because they appreciate the deal flow that I give them. But I think there are banks that will do that. It's, some banks, they just are very strict on their geographic footprint. I don't know, do you guys go out of state or deal with out of state borrowers?
We'll go out of state, but normally for somebody who's in state, but you have ties here. So then it's really who does the kind of lending that, I mean, I don't know how many properties you have. Some banks love doing that, onesies, twosies, fives, up to tens. Some community banks, they only want to deal with folks that is all they do. That's their income and their property management and developers, and that's all they do. So that's where I would say you'd go to Matt or Ricky and say who fits that niche. And I have a couple ideas for it.
Other questions?
I had two kind of like general, or one was a more general question. Matt, what is the risk tolerance for like the assisted living space? I know you said earlier like office space is more on the high side of it. What is assisted living considered?
The most attractive assisted living are the ones that don't have additional services, because the banks look at it like, if something were to happen, can we just look at this as an apartment building? So if you add memory care and other types of nursing and things like that, it becomes much more specialized, because then those facilities have to have on-site like exam rooms or maybe like a catering area, and then that asset is no longer convertible. It becomes more special purpose. So it's just a function of what's inside there.
Okay. And then the second question, I think you guys pretty much answered this, but if you could more overemphasize the whole purpose of going to individual banks, because at the end of the day, to me, you're just looking at the numbers. And so if for nothing else, it's just to go to the 15 different banks and get me out of my comfort zone. That's cool, but at the end of the day, aren't you just basically looking at the numbers anyways?
Yeah, I mean, do you want to go and date 15 banks? Or just pay a few $1,000s to do it? That's what we tell some customers. Because you're going to have to retell your story over and over and over and over and over again. And we'll tell it in 15 minutes. We do a deal summary, we run the cash flow model, we do a quasi-offer memorandum for you, and we know where to go. You may have your credit pulled a bunch too. So odds are, if you're new in the business and you don't have the relationships that Matt and Ed talked about, you're going to fail. Or at least you may succeed, but you will succeed with probably a worse deal than we could find. And we're very confident. I mean, our company closes almost 1,000 transactions a year. Our Milwaukee office is over 100 year to date in this lending environment. So we get hired because we close deals.
You talked about the assisted living space. We know it really well. Chairman of our board is Jim Tarantino, who is CEO of Capri Communities. And I have a lot of background personally in financing that. But then if Ricky or Matt, and they've got to find a bank that understands that kind of lending? Are you going to stabilize it over 3 years, interest only? How are you going to put your equity into it? Are you going to flip it into a secondary market? Are you going to, and Ricky asked the good question, nursing's really tough. Nursing home side of it, memory care, assisted living. Those deals are pretty strong. The demographics are great. You need a banker who can talk like that. And maybe I've done a really good job of faking that I know what I'm doing on that, but we've done 5 or 6 of those deals in the last 5 years. And they're really good operators, and I've even helped some go to the secondary private bond market, which dried up at COVID, but I helped in regards to a $200 million placement of 14 of those. So these guys make calls and say, what do you know about assisted living? I can't, have no idea. Or you have a bank that has numerous folks and they like doing it.
All right, one more question. We'll wrap it up here.
Yeah. You guys touched earlier on assuming like the government loans, but you said like usually they don't go through if people aren't as strong as the people they're taking them from. Can you guys touch more on that subject? Like assuming?
Sure. So I had a client, only did bank debt, and he had $250 million in bank debt, which sounds like a lot. It is a lot, but he had, $500 million or something in asset value. So his leverage was not that high, even though his debt amount was high. But the debt amount started to keep him up at night. So he's like, I need to go non-recourse with some of my stuff. I didn't really see the need, but I'm not him. So, let's get you some quality sleep. And he went Freddie Fannie on maybe 60 million just to see, kind of dip his toe in the water and see what that was like. And he liked it for about a year and a half. But he's a wheeler dealer. He doesn't just sit on his portfolio. He's constantly churning, buying, selling. He loves the deal. So the whole time he's like, these are assumable loans. This will be fine. I can keep doing what I do, keep my business model going. Well, the first deal he had, he found someone to buy it. And if I remember right, they had a net worth of $80 million with like 10 million liquid. Fannie Freddie said, no, we're not going to let him assume your debt. And it came down to the answer of why was my guy was worth, twice that at least, and he had more liquidity. So they felt like even though it's a non-recourse loan, they're still looking at him personally and saying, we like you as our borrower better than we like this new guy. So if you go to Freddie Fannie or a different agency and, if you're worth a couple $1 million and you've got a few hundred liquid, then I think it's less of a risk that you'll find someone to buy it that's on an equal playing field as you. But I've seen when you make a ton of money, then finding someone that they will actually approve the assumption for is near impossible. So the end of that story was my guy paid off all of his Fannie Freddie debt and paid, I think, like a 2-point fee just to get out of there, so we had the flexibility. So it was a short-lived experiment, and it didn't go well for him.
It's a sponsored downgrade to the agencies.
It's a what?
It's a sponsored downgrade. They have this great signer, now they have a not so great signer in comparison.
Oh.
All right, well, let's give it up for these guys.
Thank you. Appreciate it.
That's great.
Thanks.
Back.